we'll start with just trading versus investing. What's the difference? Well, trading is is typically what you'd think of as like a day trader, somebody that comes on, looks at the market from like on a daily basis and looks for edge in the market to capture quick returns and thinks of it as more of like a short-term position, with the ultimate goal of always gaining in US dollar value. And in some cases, I would say like a lot of the smart OG crypto whales, they think of things in terms of Bitcoin or Ethereum, because those are like the metrics for measuring wealth in crypto. So in the early days of crypto, when it came to trading, you really measured your account in Bitcoin. And today, you have two types. You have people that measure their wealth in US dollars or stables, and people that measure in their Bitcoin or Ethereum value. And so with this trading versus investment thing, a lot of times you can apply this trading skill to either figure out good areas to dollar cost average your way into the market, or you can like actually actively trade a portfolio on a daily or weekly time frame. So trading is more short-term focused, but you can use the skill of trading to use it to get better prices on long-term investments. So I think breaking that down for people first is probably a good starting point. I hope that explains that part.
And what about swing trading too? I know I've heard people talk about swing trading and in crypto. Is that, how different is that in traditional TradFi versus in crypto and our ecosystem in particular? Are there interesting possibilities for swing trading?
100%. So swing trading would be more like the medium term. If you were thinking about the market on like on a cycle level, so you're thinking like 4-year cycles or 2-year cycles or 6-month cycles. I mean, there's opportunity in like the total crypto market cap here. If you're looking at it broadly, what if, I mean, it's so simple. If you could just sell here, buy here, sell here, buy here, sell here, buy here, sell here, buy here. I mean, that's what you're looking at when you're looking at swing trades. So just like briefly, like you really want to define like how long you're going to be in that trade for. And it starts with a trade idea. So perhaps maybe you would have been looking at like the market over the last couple of years and you would have seen something like this. And at this point in the cycle, it's good when you're thinking about these long-term swing trades, like, what's a good context to position myself to make sure that this trade is successful, and where is it invalidated from? So if I'm looking at this price action here with no indicators and no other context, I would want to have more context on catching this swing trade. But like one way you could get context would be like if you zoom back out, and this is the one thing I try to remind people is you always need to zoom out and get the most data as possible. So when you're looking at the total crypto market cap chart here, this is as much as I can get going back to 2014, spring of 2014. Okay. And so what I would do, maybe here's an easy one. For our trade idea, let's measure based on time. So I'll go in here and I'll look for like the date range tool. And I would count the number of days, let's say from this top to this bottom. And like that's saying that it's 343 days. And then let's say I just wanted to apply that. We can see a clear cycle here. Let's just apply that to the following cycle and see how far off it was. Well, in terms of that particular data point, how would I know if this was the bottom here or not? Well, this particular cycle had different price structure. So it didn't do this big run up and create a blow off top. Instead, this time it did like a move up and then a rejection and then a second marginally higher high. And so that because the structure is different, straight up, straight down, and this was straight up, and then straight down, you'd want to use that in your analysis. So then if we use this as the top, the second top, how close are we to the bottom this time? It looks like it was based on the previous cycle, you were literally 21 days off, about 2 weeks off of the actual cycle low, basing it off the previous cycle. So you could basically take this information and now you have a process for measuring time on a chart. And, as things go forward into this cycle, you could have taken a swing trade down here and said, hey, Based on past performance, this was the low about 343 days in, and based on this performance, we're 343 days in. We got to be getting close. So you'd start to scale in here, and the idea is like you need to have a clear invalidation. So like at this point, you can't come in with your whole stack. Obviously, you'd want to come in with a portion of your stack that you can dollar cost average into the market with. Because if you're like, oh, this is for sure the bottom, we're close to 343 days in, and you put in your $10,000, it's everything you saved up here, and then the market crashes an additional, let's see, 27%, you might be shook out of your position. You might be like, oh no, I was wrong, and now I got to sell. And so it's on these longer term time frames. It's good to measure things like the time and like the total drawdown from past cycles into future cycles. So it gives you more of like a template to go by to find these like longer term swing trades. And never come in with your whole stack all up front. You just want to come in with bits. And this is like easier said than done, because like when you're convicted in something and you think you're right, you're going to have a tendency to want to put more in than you should at that time. Because if you wait, then you could buy more down here. And then as this starts to come up, you get confirmation that you were right about your trade idea. Now, like at what level would, if this would have kept crashing down, like at what level would you invalidate, say that your trade was invalidated, and have to make a decision? Would be you'd have to set that goal outright. So in the case of previous Bitcoin cycle here, the total market cap, it fell minus 88%, and in this cycle, it fell only 75%. So you were good if you followed the theory of 88%. You were good all the way down here to 364 million. Or let's see, hold on. Yeah, 364 billion dollar market cap of all crypto. So like so it's kind of interesting, right? Because this cycle was a lot nastier in terms of like percentage down. But maybe that was your invalidation level. Would be like, hey, if the total crypto cap breaks below like 360 billion, I gotta cut my positions at a loss. And as long as you didn't put it all in there, let's say you bought some there, you bought some there, you bought some as it fell even farther, then at least you're DCing into the market, and then you don't have to like kill your position at a loss until like it invalidates your level. But when you're talking cryptos, like it's probably a better theory to just, you could take these swing trades on these like 6 month or 12 month or cycle theory, but then you're kind of in it, at some point, and you shouldn't be looking to cut a loss at a low, versus like a day trader, which would definitely want to have clear stop losses, and you would only swing trade an asset that will survive. So it's kind of interesting where we're at with Pulse, which is a first cycle coin, and Hex, which is on its second cycle, where we're at in the market right now. Because there's some people that might think that it's not going to make a recovery or it just won't perform the way they thought it would, and so it's really putting into question that trade in a lot of people's minds, which is good because it means that not everybody's on the same side of the fence. Any comments you had on that swing trade kind of theory?
No, I was just thinking, so is there a different, I guess one interesting place to explore here too is, are there different places, or you mentioned coins too, like maybe, I guess what frame of mindset would you have to swing trade Hex and PulseChain versus some, like a meme coin or something that you don't think is going to be around for a while? Like what kind of, is it you just adjust your amount that you put in it? Like what kind of, when you're looking at the different types of coins with swing trades and otherwise, how do you adjust, your investments in these?
So yeah, it all comes down to portfolio allocation and having a clear divider line for this is the stack that I'm holding for the long term because I really believe in this product or this asset, and then there's the stack that's the trading stack that part of your portfolio is like actively can be used to make moves on different assets, right? And so like the long term stuff you should kind of just put in there. Maybe you're hedging any downside price action with a yield bearing instrument or staking or mining. That kind of goes. This can be said for like Bitcoin mining as well, where like some guys that are in Bitcoin, they'll just go hard on a mining facility or have exposure to the miners. which is like a hedge for downside risk because then at least you're producing more through a revenue stream in case Bitcoin price goes down. If you're just a holder of Bitcoin, you're totally reliant on the price if you're not a trader. And if you're a trader, then you kind of have other tools like shorting the market with like a leveraged contract position on margin, or so like you have so really the person that's the worst off in terms of they're basically have to let the market do what it's going to do is a guy that was to just, let's say, buy Bitcoin spot. It doesn't produce any more value for you. It just sits there and you have to hope for the price to go up effectively. So it's like the weakest position you can take, but it's also the one that won't wreck you in terms of like, Bitcoin will rise again. It's already established. So I think that kind of explains the different tools that you can use. But here on like Hex, for example, I think it'd be important to show a simple strategy for how to catch a swing trade on this chart. Because if you just held from the top, let's say you didn't capitalize on any of these big explosive moves up, 200%, 140%. This was like 600%, 300% from the low. It's like, well, how do you know when it's going to finally do its move? And how can I more effectively swing trade this with my trading portion of my bag that's not like my staking bag, or that's not allocated somewhere else? And two tools that I like to use on the indicators here is the RSI on the weekly and the MACD. They're some of the most prevalent tools that a TA person will use, or like they're really good at showing you zones of overbought and oversold conditions. So without going into the depth of like looking for bearish and bullish divergence, which you can do these things too, you could simply have put this RSI on the weekly, pull this up on Hex, and then if you come into the inputs here, normally it defaults to 14. So it would look like this, which doesn't give you enough resolution to find edge because these are pretty flat zones. So you can't really, they're not really telling you much as if you come in here and you cut it in half to 7. Now you can see more clearly kind of the edge in the market. Like if you just simply sold these tops and then bought these lows on this weekly RSI, you would have made money swing trading this chart. So like Hex was really probably one of the easiest things to swing trade in the past like 2 years, because it literally on the RSI gave you the whole story right here. And like in terms of percent moves from each one of these, just to kind of show you the proof is in the pudding, that one would have been 219 from that low. From this low to this high would have been a 78% move. This one would have been 140% move. And they take these plays, they happen over months of time. They don't happen over a few days. So you kind of have to be convicted, and you have to zoom out and look at this on a weekly. Because if we like go to a daily, for example, it totally changes the RSI in a way that it's unreadable. Like you'd have to be pretty adept to figure it out. I mean, you could kind of see the same relationship where whenever the RSI would go below the 30 level or the 22 level here, let's say, which is right here, that was like the best time to buy Hex over the past 2 years. So you can capture the data points on different time frames, but usually the bigger the better. And then down here on the MACD, I look for bullish crosses on this MACD. So when the MACD goes below the 0 line here, you look for these green little arrows, which I put in here just to signify the blue MACD line crossing the orange signal line. And anytime that you get a cross up, it's bullish, and every time you get a cross down, it's bearish. But the bullish MACD cross doesn't mean that you're going to see immediate results. So this, for example, this bullish MACD cross came in right here on the price chart which resulted in a 74% move, but then in the following weeks it actually fell 75% over 140 days. And so your job here would have been to recognize this bull cross down here and just continue to like bring portions of your bag in over this period and DCA in with conviction. And then finally, when this RSI bottomed here, it was the same. The MACD was still moving and put that bottom in there. It wasn't until we got that cross up there at this price level here, when the fork happened to mainnet, that this MACD flipped bearish. And you can use it. You can combine these tools to find the Pico tops and the Pico bottoms, right? So, kind of combining just those two simple tools can give you a pretty good edge in terms of like swing trading, which is probably a lot more effective of a strategy than day trading. Day trading you could get marginal wins there's so much more risk you're taking versus, you risk losing units of crypto, but by big upside moves, and you risk opportunity costs somewhere else.